fireside chat today has got Rishikesh and Rahul joining in. Let me stop my screen share and remove those photos because I would like to have our speakers on the screen. So let me bring in Rishikesh first. Rishikesh, how do I? Okay, I am going to spotlight you. Yes, Rishikesh. Let me introduce Rishikesh first. Rishikesh has got more than 2 decades of well rounded experience, including technology investments, business acceleration strategy, marketing and communication strategy, strategic alliance relationship, sales channel development and management, business excellence models, market research, and analyst relationships. He's got a very wide experience. He has been an angel investor, a board member, and advisor in more than 30 initiatives accelerator angel fund, including tech product platforms across GTM tech, micro vertical focused analytics, no code platforms, enterprise tech services across multiple industries, and so on. Like so, it's the sheer breadth of the initiatives he has been part of as an active advisor. As an operator entrepreneur, Rishikesh has been driving GTM initiatives for globally and locally emerging leaders in B2B tech organizations, including SAP, Microsoft, Infor, Epicor, Fujitsu, HPE, Lenovo, Finestra, IBM, and there are so many other names which are the who's who of the industry, and you would surely know them. Right, Rishikesh is also the president of executive committee for Supply Chain and Logistics Group, a 27-year-old policy-centric industry body under Dubai Chambers with members in 40 countries. He has got a bachelor's degree in chemical engineering and a postgraduate in management from IIM Mumbai, and he enjoys playing chess and study of astrology. Right, quite a diverse set of interests and investments, I would say, investments of his time and energy. Well, that brings us to our next speaker on the fireside chat. Let me invite Rahul on the screen. Rahul Arora. Let me introduce Rahul. Rahul is the leading voice in sustainability, strategy, and finance, with over 15 years of experience working at the intersection of climate, ESG, and business performance. Currently a partner at ERM, the world's largest dedicated sustainability consultancy, he supports global organizations, investors, and institutions in navigating the rapidly evolving sustainability landscape. His work focuses on helping businesses identify what truly matters, translate ESG and climate strategy into financial outcomes, and communicate these effectively to regulators, investors, and the most important one, the stakeholders. He has advised over 100 organizations across North America, Middle East, Asia on areas including decarbonization, sustainability reporting, and sustainable finance. Recognized as a LinkedIn top voice for corporate sustainability in 2024, he's passionate about helping organizations move beyond compliance to embed sustainability into core strategy and long term value creation. Thank you guys for joining. Thank you, Rahul. Thank you, Rishikesh. The stage is all yours. We are waiting to listen to your conversation.
Thank you so much, Hemant, for a good introduction. And thank you, Rahul, for joining us today. I know it's a bit early for you in US, Canada. It's around what, 7:30, 7:35 your time?
Yep, 7:35. Thank you so much, Rishikesh. Really appreciate the opportunity to share my insights with all of you all and look forward to having this conversation.
Wonderful. So, since this is part of Capital Conclave, I'll just try to hit the six for the first ball itself. So, if you were given a choice, would you rather invest in a company with strong financials but weak sustainability, or one with strong sustainability but average financials?
So I'll answer this question, but in a slightly different way. If you think about the topic that we're talking about today, it's focusing on climate tech, carbon markets, and energy markets. 3 years ago, climate conversations were driven by ambition. Today, they're driven by scrutiny. And over the next 5 years, they'll be defined by execution and returns. From where I sit, working with corporates, private equity, institutional investors, climate is no longer a narrative, it's underwriting. Would you ever buy a car without insurance? Would you buy a home without home insurance? Same way, if you think about it, and that changes everything on what gets funded, what scales, and what quietly disappears. So climate or sustainability is no longer a good to have. It's an essential for business, whether you look at it from a risk management perspective, or whether you look at it from a strategy perspective, or whether you look at it from a doing your business. Where we sit right now, there's a talk about a $275 trillion transition globally. The capital is there, the technology is there, but the execution is where the gap lies. So it's all about execution, and there's no company that's safe if they're not sort of on the right path to doing business properly.
Interesting. So, a few, clarifications that people usually get it wrong in this particular space. How would you differentiate between, let's say, an ESG versus real sustainability as an organization when you go into an organization for auditing?
Oh, absolutely. So one is the audit perspective, but one is also understanding fundamentally what is ESG and what is sustainability. Uh, Sustainability is coined by the triple bottom line, looking at people, planet, and profits. There was this tendency when the profits were slightly on the lower end, the focus towards people and planet started disappearing. So the financial institutions and investors, the private equity, realize that ESG is really important for businesses to thrive, and it stands for environmental, social, and governance. So there were dedicated parameters for companies to focus on, to report on progress, to ensure their standardized view. And after that, there's been a lot of movement in this market. So whether you look at it from an IFRS perspective, there's IFRS S1 and S2 frameworks that are sort of accelerating sustainability and connecting the finance side to it. And then there's the CSRD in Europe. So there's a lot of movement in this space, which is connecting the financial side to the ESG side, so that there's consistent reporting and consistent disclosures across the globe, across companies, so that the financial aspect of sustainability and ESG can be looked at from an overall perspective.
Understood. Where do you think most of the companies get it wrong, and consulting organizations such as ERM come in and make it right, kind of?
I think one is the first thing is you need to understand where the company is, at what level they are, at what ambition level they are, and what's their vision for the future. There are companies that are already ahead of the curve and they know what they want. And then there are companies who've been subject to legislation, not sure what's going on in this space. So it's all about starting with a deep dive, understanding what's material to your business, doing a deep dive materiality assessment or a double materiality assessment if it's required by legislation, to understand what's focusing with your business, what aligns with your business, where is it that you're headed, what is it that you think you should be doing, and putting the money in the right set of resources around it. And once you have your materiality defined, it makes uh, doubling down on that much easier for companies, knowing where the vision is and where the strategy is before investing the funds. What companies mostly focus on is on disclosures. But if you think about it, disclosures is the end outcome. If your strategy is not robust and if your execution plans are not robust, your disclosures are only going to be poor. So it's all about doing the stuff first. And disclosures are generally what you've done in the past 1 year. You need to focus on what you're doing today so that you can disclose upon that in the following year, because that's dated information. It's more about today, what you're doing right. And in a world where we're looking at social media, which wasn't a communication, say, 2 decades ago, companies are using that proactively to leverage on what they're doing in communicating and interacting with the audience, whether it's interacting with their suppliers, their stakeholders, their investors, their customers, or even their own employees. It's about leveraging sustainability and climate into their day-to-day business, and how do they sort of impact communities around them.
That's interesting, Rahul. So what you're essentially trying to say is that there is a clear difference between just reporting what is happening versus a genuine transformation that a business owner and the senior leadership is expected to, do within the organization with the sustainability mindset. But don't you think it is just too much for a senior leadership? There's already so much of disruption happening with the advent of AI and tech and those things. The communication channels have become extremely, varied, At the same time, a new way of looking at doing business itself is being inculcated, right? It was not easy to do business in the past,
Right.
just from a case of doing business itself, right? From a competitive strategy standpoint, right? Because there are other competitors out there, there are alternative products. How do you manage your channels? How do you do this? And on all top of it, now you need to do it sustainably, and you need to drive through this transformation while making sure that your business is, in a way running. And so how, I mean, I would like to think that it's extremely difficult to do that, isn't it? What's your view on it?
So it's a different way to look at it. I understand where you're coming from, but again, the other way is if you do it right, it's going to impact your business in a profitable way. To give you an example, if you're going to focus on your supply chain, you're going to be able to cut costs down. If you're going to be focusing on efficiency measures, whether it's energy efficiency or water efficiency, that's going to drive your bills lower. So it's going to impact your triple bottom line. So it's all about value creation. What is it that you're doing from a sustainability lens that's going to impact your business in a positive way, and it's going to help your company sustain for the next few generations to come. We have clients that work with major Fortune 500 companies, and they reach out to us saying that they need to set a science-based target. And when we talk to them about do they know if they have their scope 1, 2, and 3 emissions sorted, they don't have answers for that. So it's all about knowing where you stand in that journey. Do you have a control over your emissions, and what gets measured gets evaluated? And if you don't even know how much you're emitting or what's your overall performance, how will you measure that? How will you control that? How will you reduce that? So it's all about using sustainability as a financial driver. And when you look at it from a financial lens, we have buy-ins from the CFOs and CEOs on a constant basis because they realize it's important to business. It's about doing business the right way, but also the profitable way. And how do you create value within your organization, and you are set ahead of your peers and your competitors rather than seen as a laggard in this space.
So what you are suggesting is that if done right, the initiatives in the sustainability ESG space can actually create a better multiple in the public markets or in the exit valuations, etc. Would you say that, something like that is possible?
Oh, absolutely. We actually did a deep dive study a couple of years ago, and there's always a company which helps companies reduce their risk profile and lowers them, and that's where sustainability and ESG comes in. And there's definitely investors are willing to pay a premium for durable margins that are less susceptible to regulatory shocks or environmental disruptions. There's also a growth alpha that we've seen in companies. It's also about there's a green premium. We've also seen that as well. So companies that have been successful transitions or are pure play, their EBITDA is higher than their peers, and then there's a brown discount. So companies have to pay higher insurance premiums, wherein it's not the right set of values that are integrated. So it's all about knowing where you stand. So sustainability isn't just a cost center anymore. It's a strategic lever to improve the quality of a company's earnings. And that is exactly why markets rewarded with a higher multiple and rather than others.
Interesting. So we spoke about green premium. What about greenwashing? Aren't those also issues that we are seeing in the market?
That's a massive risk, and it's a PR nightmare as well. Initially, a lot of sustainability teams sat within marketing as well, but that's changing more and more, wherein the entire investor relations team or the EHS and sustainability teams are now ensuring that the messaging is right. So there are anti-greenwashing rules. Canada has one, the US has one, there's FCA in the UK. ESMA in the EU has introduced strict naming and marketing rules for investment funds and corporate claims. So there's also a litigation risk we are seeing. There's a surge in climate fraud lawsuits. Companies are claiming to be net zero by 2030, 2050. But if you ask them what's their pathway, how you head there, they don't have answers for those. So that's where data integrity, assurance of your third-party data are really, really important. Because once your brand and reputation gets impacted, it's really, really tricky for companies to sort of have a successful comeback if they don't have data that's available out there. And the last thing you want is your company getting caught up in legal and financial frauds by sort of using sustainability as a driver without having anything that you can demonstrate as value to your organization, or something that you've really done. So companies need to be very careful about the way they disclose their data, have legal teams integrated with their disclosures when they're disclosing that. So it's a combination with their legal teams, their sustainability teams, their marketing teams, all of them working together rather than it being done in a silo, one-on-one. We also get queries at times wherein companies have their annual report that publishes one set of metric, and then they have their sustainability report that publishes a different metric. And we had a SOS call from one of the executives saying that, hey, one of our investors has flagged this. What happened? Can you please help us? And then we had to tell them that the disclosure year for your sustainability report is different compared to your annual report. And then they asked, what's the best practice? The best practice is your annual report and sustainability report comes out together. That way, the data stays consistent and constant throughout, rather than you having different years of reporting. And then they moved on that path and they've never had challenges. But again, it's all about ensuring that sustainability is measured with the same lens as your annual report, and then you won't see such concerns at all.
So that's very interesting, right? So what you're essentially saying is that, this goes especially for the public listed companies, right? Because they need to
Yeah.
publish their reports every quarter and and annual report for sure, right? And what you're essentially saying is that they need to start building. Initially, they have been used to over the last many years and decades to have their financials through a certain cycle, auditability, etc., so that they can come out with the quarterly and annual reports, right?
Yeah.
Now you're saying the new framework of sustainability also needs to be put in place, right? At the at the same time scale, so that they would come out with a quarterly and an annual report on the sustainability data structures at the same time as financial data structures, right? Now, when an organization has to move in such an environment, because a lot of these things is leading and is coming from the data collection part, the way they have structured their enterprise tech and all the rest of it, right? Which may create, may not create. It's a question to be asked. In terms of will this kind of regulations and additional burden on the organization slow down innovation? Will it create a sort of a bureaucracy within the organization to get certain things in place? What is your view on that?
It's a really good question, Rishikesh. What we are also seeing is that, yes, companies have their annual sustainability story, but they are also having quarterly sustainability statements that are more rigorous and sort of the frontiers in corporate reporting. They have the same ESG data governance that they have for financial reporting. And this has been possible where companies have sort of moved away from manual calculations to automated data platforms that integrate within their financial reporting system as well. They have internal controls and assurance readiness already built in. It's seen as a day-to-day function. The way there's internal audit within business, that's how internal audit is sort of ensuring. There's also seen a rise of an ESG controller within a lot of these organizations, whose role is to ensure that sustainability and finance teams talk to each other, and there's accurate data being put out in the market. It can seem strenuous, but at the same time, if you think about it, it's also from a risk management and evaluation perspective. And once brand is diluted or it's impacted, companies don't want to risk that effort. So this is something companies are looking at as a day in, day out procedure, wherein data that needs to go out needs to be accurate, ensure that there's no greenwashing going through it. And at the same time, it has all the checks and balances before it's made out there in the public domain.
Interesting. Now, let me touch upon this subject from a slightly different angle, right? The purpose of the entire regulatory framework is to ensure that we leave a better planet for our next generation and the generations after that, right? What if, for some strange reason, ESG norms disappear tomorrow? do you think that good companies or those companies who have genuinely invested into it still behave sustainably, or do you think they'll go back to their previous ways of working?
That's a good way of talking about it. I was speaking to one of my friends who works in one of the other firms, and they dropped the term ESG completely. And they said, "Are you all keeping it in your organization?" We said, "Yes." They're like, "Now, no longer ESG, we're going to call it sustainability." And after a little while, he called me and said that, "Hey, we're no longer calling it sustainability, we're calling it business resilience." So it's all about business resilience. How do you place that? So it's not just sustainability in one way. You can drop the term, you can drop the acronym, but do you have operational resilience? Do you have resource efficiency? Do you have energy security? Now, those are aspects that are not disappearing anywhere. How do you bottle it? How do you place it? How do you position it? That's a different way, but there's always there's supply chain challenges. One is the physical reality as well. There's extreme weather events, there's water scarcity, resource depletion, challenges to obtain critical minerals. But at the same time, companies need to demonstrate progress, growth, ambition. There's challenge with AI data centers. Where do you get the energy for that? So it's you might not see the term ESG and other terms, but eventually there's going to be an era we're going to see sustainability in stealth mode. How do you use it to activate business? It's no longer it's no longer a set of rules. It's about how do you embed it in your engineering, finance, and logistics, and how do you go to market. There are companies that ask me, do we need a separate sustainability strategy? I said, you don't need that if you have a business strategy that embeds sustainability and ESG principles. If you're looking at that in your business strategy, you don't need a separate strategy. You can have one that embeds everything. And how do you go to market? It's all about utilizing that information from a financial perspective, and how do you drive value for your business and create value.
Yeah, very interesting. So what you're saying is that unless you are able to embed sustainability as an integral part of the business strategy, right? And if we continue to think about it as a separate element to be just reported out to because of the regulatory, there will always be a friction. But if we are able to embed it, then it can be a much more resilient and a much more stronger business strategy, because you will by default make sure that certain things that are getting wasted under normal circumstances don't get wasted because sustainability is embedded. I think that's a very important point. So I think there's a lot to learn about sustainability, especially in the emerging markets out here. You obviously are talking about a lot of work that has been happening in the developed market, but let's say there is a lot of things to learn. What do you think that there might be something that we may need to unlearn, or something that we are doing today as a practice within the sustainability, and maybe 2 years, 5 years, 10 years down the line we realize, oh, that was an error? What do you think is an error which has become part of the regulatory framework, right, but we may have to take it out? What could that be?
So I'd say there's this close-mindedness which a lot of companies have right now, wherein they look at whether it's ESG, climate, or sustainability from a compliance lens, and the narrative is more around we have to. They see sustainability as a cost and a constraint. But then there are companies who look at it from an optimized stage, where they think we should do this. Sustainability is an efficiency play, doing more with less. And there are companies who are already transformating and in the transformation stage, already seeing benefits and saying, this is who we are. Sustainability is a competitive advantage and a growth driver. Eventually, the goal is to reach a point where the CFO and the Chief Sustainability Officer, CSO, are looking at the same dashboard, where the green return on investment and the financial return on investment are viewed as the same metric. The friction disappears because the entire organization is finally pulling in the same direction. It's not about having adequate disclosures and ambitions. It's about the execution. Until you don't have, so the biggest challenge for anything, whether it's climate or sustainability, is the execution risk. And companies that are able to maneuver that will be the ones seen as leaders in this space, and get the value that they desire from a value creation perspective and a higher premium perspective.
Interesting. That's a very interesting thought. Let us touch upon something that everybody is talking about, how AI is disrupting the global markets, right? How do you think AI is getting integrated into sustainability or becoming an integral part of sustainability? How is sustainability proponents taking up AI within themselves to utilize? Because to, as you rightly pointed out, to to use AI itself is not sustainable because there's a lot of data centers required, the computing power that is required, the water systems that are required for cooling, etc. How do you see that aligning?
So this is something where we are seeing AI is actually helping drive from compliance to competitiveness. If you think about it, AI is in a way reducing times. It's by automation. So AI agents can now read thousands of utility bills, supplier invoices, travel logs, automatically mapping them to the different disclosure frameworks, whether it's the GHG protocol or CSRD disclosure lines. So they're accelerating the speed of disclosures that would have taken, say, 1,000 man hours. It's being automated. It's able to even flag anomalies. So if they see a data trend that's looking, there's a several spike up or spike down, it can immediately flag and say, hey, this looks something wrong. Do you want to double check that? And that way teams are able to leverage AI. It's also helping companies be audit ready because AI is able to sort of have evidence bundles around why this data, what's the calculation, how it was calculated, along with data that's already there from a source documentation perspective. So I feel data sort of AI is enabling sustainability more, and it's helping fast track sustainability drives for companies. It's only going to help companies move much faster towards their sustainability goals because AI is going to help streamline a lot of data, a lot of disclosures, what the company has done, and help them accurately predict whether it's their energy footprint or their overall efficiency measures, how they are calculating it, and what is it that they're doing.
Interesting. Now, it's a very interesting thought. I'll just touch upon one last thing before we conclude. I think we are hitting the timeline as well. Uh, there are various initiatives that are running at a global level, like the COP initiative, right? So you have the COP 1, 2, 28, 29, 30, right? According to you, how are those initiatives supporting the overall sustainability practice globally, right? What are they able to change, and what is it that they are not able to change as we go along?
That's a very interesting question because again, it's very diverse, very difficult to answer that in a few minutes. But if you think about it, the Conference of the Parties, as they call it, COP, it's a high-level diplomatic summit used to sort of have a massive global regulatory catalyst. They're no longer talking about saving the planet. They're also about setting the price for carbon, the rules for disclosures, the flow of capital. There's a lot of talk about transition away from different fuels. There's been different COPs. There's also a nature COP that focuses on nature parameters. So it's also about standardization. And by that, what I mean is that by supporting events such as, by supporting frameworks such as the ISSB, CSRD, COP sort of provides the common language needed for maturity amongst these companies. There's also COP around where initiatives such as global renewables and energy efficiency pledges. It's also about ensuring that companies and countries are able to help each other support if there is investment in certain stages. How can they accelerate and how can they share technologies so that there is a good drive for everyone? And end of day, it's all about being data driven, being strategically aligned, and being mature in your practices. So it's all about COP is effectively institutionalizing the green premium, and they're trying to set rules in which companies can thrive, nations can thrive, and how can they work together collaboratively in the day of AI to ensure that there's premium driven for everyone and there's growth for everyone while looking at it from a climate and sustainable lens, while ensuring execution is the main focus and companies move forward in the right direction. I hope that answers the question, or have I missed certain parts?
No, I think it is fairly there. So, would you say that the next generation of founders won't be adding sustainability, but they will need to start with it as an integral part of their startup pitches and the way they set up their business strategy itself when they are starting a new venture?
Oh, absolutely. We are seeing already a fundamental shift from sustainability as a department in the legacy model to sustainability as an architecture instead of the founder model. So companies are no longer they're using it as a native advantage. There's no legacy debt that they have. They're using it even in startups that we are seeing. They're using AI and sustainability and ESG as a parameter from day zero. This creates sort of zero friction because it's the way of doing business rather than trying to integrate a new habit. And they're also seeing it as a growth hack. It helps them with audit readiness and also helps being a talent magnet because eventually the best engineers and operators are choosing purpose over a paycheck. And then companies want to attract the best talent that's out there. So it's all about stealth integration, ensuring that they're doing right things from day one. And it's much easier if you have set processes and controls from day zero rather than trying to integrate new things to do in the future. It becomes a part of the way you do business. And that's what we are seeing newer companies, the newer startups do from day zero itself.
Interesting. So we spoke about the startups. Now let's look at the larger organizations, right? Where trying to integrate and trying to build sustainability practice is a major work to be done. Now, a lot of times we have heard in the past, all this senior leadership gets bonuses based on how the company has performed, based on the revenue numbers and the profitability numbers, based on the market cap. Do you see, or does it already happen in US? You may have to put it accordingly, that the senior leadership's compensation is also having a line item of their achievements on the sustainability growth standpoint,
Oh,
or
that's a
the
fasc
milestones that are being put forward by the board and the senior leadership. Does that happen? Should it happen? Your views on that?
So I would say there was a statistic recently wherein around 70 to 80% of the global large companies of the S&P 500 at least had one ESG related metric in their executive incentive plans. So it's
Hmm.
it's already in existence, but it's shifting towards a more specific quantitative targets rather than broader targets or broader modifiers that could be used in sort of trophies and awards that they've won. So it's moving more towards that direction. The other companies also we've seen where many boards are now using CDP scores or science-based target initiatives as gatekeeper for bonuses. So there are ways where companies are looking at it from an overall lens on how does it sort of impact their financial models, whether it's their revenue, EBITDA, earning per share, and eventually there's discretionary board top-ups as well that we've seen from an ESG perspective. So if you don't meet your targets, you don't get that additional bonus. Otherwise, there's the additional bonus as well. But again, you need to realize that companies were created from an overall perspective of creating profits. And if ESG is going to drive your profits, uh, companies are going to start focusing towards those. So if it's done the right way with value creation as a parameter at the back of your mind to generate more profits, companies would look at it from a strategic lens rather than a standalone KPI of what needs to be done.
Wonderful. So what you're essentially saying, if I may just try to summarize what we've discussed, is that if capital is the fuel of the future, sustainability will quickly become its filter. So if you're not passing certain elements on the sustainability filter, you are uninvestable, I would say, right? So it's not just about as a business whether you are investable or not. The question then would be asked is, do you deserve to be invested into if you don't have the right sustainability practices in place? Would you say that that is or can become a reality as we go forward?
I would answer that with a different example. So this was roughly a year ago, wherein more than a year ago, wherein we had one of the board members call us and say, "Hey, we want you to help us get an ESG rating for a company we are planning to list in the market." So the company is not yet listed. They're planning their listing, and we asked them, "Why do you want to get an ESG rating now?" And the honest answer was that one of the previous companies that we had listed, they got a beating on the stock market because they were flagged on their ESG performance being low. So we didn't get the multiple that we were anticipating. And they said, we need your help to sort of get a good ESG rating, ensure that we have ESG systems and processes in place. And when we started out, they had a slightly lower rating than what they would have liked. But what they had was a roadmap to work against before their listing plans. So they knew where they stand, what is it that they need, and what is it that they need to action on. So they worked towards it. And finally, they got a reassessment done and they were rated an A. And they were very happy with an A rating with one of the leading ESG rating firms. And now their plan was from A to a triple A. And that's what they're planning to capture in their listing prospectus. And how do they sort of disclose what's their vision? How do they go to that direction? But what they were very clear is that had they not done that, had they ended up with a poor rating before their listing, that would have impacted their overall stock listing. But right now, they have an A rating. They've captured all the buckets. Yes, there is a roadmap for growth to achieve AAA. What are the other measures? And they're working towards them. It's going to take time for them to reach that level. But again, they know their path. They know the direction in which they're heading. And that's what companies need to understand. One is where you are. Where do you stand? What is your current level of emissions and data and environmental data and social data and governance data? Do you have a control over that data? Do you know what your ambition is? What is the direction you're heading in? And what's the roadmap for that? So again, investors care about the direction a company is headed in and are they aware of their current performance rather than companies, if you ask them, do you know what your emission data is? And they're like, we don't know what that is all about. So it's all about being aware of how does that impact your financial aspects and how does that impact your profitability and what control do you have and which direction you're headed in. So if used rightly, it's going to help you create more profits and create value for your organization in the long run.
Wonderful, wonderful, Rahul. I think Hemant is crying out loud because I think we have slightly overstepped on time. So give it up for Rahul, who has got tons of experience on the sustainability side, a person who can tell you whether sustainability is a cost center or your next valuation multiplier. Thank you so much, Rahul, for joining us. Really appreciate your time so early in the morning and sharing with us your insights and your 2 decades of experience on this part. Thank you.
Thank you so much. Really appreciate it.